Welcome to The Weekly Trend, a podcast for navigating the markets through the lens of technical analysis. The Weekly Trend podcast is provided for educational purposes only and does not constitute any professional advice. Listeners should not act upon the information or content without first seeking advice from a registered financial planner.
Welcome back to the Weekly Trend podcast. Today is Monday, March 21st, 2025, S&P 500. Currently sitting at market open at 5667. I'm David Zarling. I'm here with March Madness aficionado Ian McMillan. We have some exciting news today.
A lot of exciting news. I assume you're not referring to the market.
I'm not. You want to be the bear? You want to be the bear?
Sure. I'll just say a quick congrats to our friend, first and foremost, our friend and co-worker, Kevin, who welcomed he and his wife welcomed their second baby boy into the world. Maybe this morning, maybe last night. Not sure. At some point in the last 24 hours. So congratulations to them. I'm sure they won't hear this, but a very big deal. We love the babies.
We do.
So awesome news.
Yep. We're so happy for them. They're playing man-to-man defense now, like you and Kate with your kids. I think it's great.
It is.
Got to keep focused on some of these things. I know sometimes people can get wrapped up in their daily jobs or what the market is doing, but stuff like this way surpasses anything like that. So super happy for both of them and their family. Excited for them. Super excited.
Agreed.
But we can pivot to stocks, bonds, crypto, commodities, you name it.
Trends up for the Ferrari family.
The trend is up for the Ferrari family.
Still a mixed bag. I mean, we still have some trends that are okay. Kevin and I noted last week that you got all four major U.S. indices are below their 200-day moving average. That is still the case. Although not all sectors. We still got some sectors that have kept their heads above water. Not everything has fallen apart yet, but didn't really claw back any ground this week.
No, and there's some interesting development from last Friday and Monday where we had back-to-back Friday and Monday 80% upside days.
Yes.
By some measures, those were 90% upside days, depending on how you count it. Typically, that's where you see maybe stocks potentially bottom, but that's time will tell. I mean, that still has to see what's called follow through. And we haven't necessarily gotten that yet.
No. Still under those July highs.
Yep. And we've got
S&P and NASDAQ.
And you mentioned all the broad U.S. indices below their 200 days. And we know that one of the best investors of the past maybe century, Paul Tudor Jones, used to say nothing really good happens below a 200-day moving average. So you have that. At the same time, you mentioned not all sectors are below. I know before hopping on here, we talked about industrials and energy and financials, communication services, utilities. Those are still above their 200-day moving averages.
They are.
Meanwhile, tech continues to be a headwind. I mean, when you look at semiconductors, technology, and really when you think about it, like the makeup underneath the surface of something like the S&P 500, I mean, its heaviest weighting is towards tech.
Yeah.
Whereas when you look internationally, your heaviest weighting is towards financials. You look at S&P, tech is about 30% of the index. You look at something like the FTSE All World using VEU, and financials is 22%, the highest weighting, while tech is 12%. So that, I mean, it kind of gives you a flavor of what we're kind of seeing out there.
We used to poo-poo on the Europeans for being so light in their tech exposure.
Yep.
And now look at them.
Mm-hmm. Well, isn't it classic? Like, okay, a Trump presidency, right? We have the election back in November. You have the recency bias of last time he was elected and what 2017 looked like, which was one of the best uptrends, low volatility uptrends we've ever seen in the US. How classic is it that you see international strength to start the year after Trump's been elected? It's fascinating. The whole trying to understand or marry narratives that are global macro or political macro. It's a fool's errand.
Just never seem to line up for some reason.
I think it's because of humans' desire to marry current information to current price, when it's really important to remember that price is a future discounting mechanism. It's looking out 6 to 18 months on the prospects of companies, economies, relationships. Yes, it might have intraday moves to some news event, but it's really about future prospects. It's a weighing machine, and I don't know why investors sometimes forget that, because I don't know what the story is. This 10% correction in the U.S. that we're seeing is one of the fastest actually that we've seen. I don't know what that's pricing in. I'm sure many people listening to this would be like, "Oh, well, it's tariffs," or I have no idea. We could fall another 10% and there's a story that comes out, but that's the bottom. I don't know. I wish I could tell you.
I have no clue. All I know is we're below 200 days, right? If you've been a long time, but probably even a more frequent listener to the podcast, you know that's kind of it's the line in the sand. Everyone I would assume pretty familiar with that's the way ADPV works. Yeah. So we sit. And it's okay. It's okay if this turns into a V bottom and next Tuesday we're above the 200 day. That's okay.
Right.
But I'm not going to sit here, right? I had a client education with a very nice lady yesterday evening. And we talked about this exact same. I thought it was, I told her it was really awesome that she was becoming a client now, because what we were going to discuss in the education was really comparable to, the environment that we're currently in. We're currently in this kind of protection mode, and it's okay. It's okay to be in protection mode for a couple weeks or a few months or however long it is, and the trend ends up resuming upward. But what we're absolutely not going to do is just assume that it's a fake out or assume that this is just going to be a 10% correction.
Yep. Because no one knows.
No one knows.
No one knows what the next 6 months bring. And you can just have a process for, if we get back above a 200-day and, like you said, the uptrend returns, fine, we'll get involved, no problem. But if we remain below here, there's no reason to hold that type of risk, because the next 6 months price could continue to move lower. We have no idea. What Ryan Dietrich highlighted, that since World War II, there's been 48 10% corrections on the S&P 500, and 12 of them turned into a 20% bear market. So here we sit minus 10% on the S&P 500. And so you're sitting in a scenario of there's a 75% historical chance that this is kind of it and we resume higher. And there's a 25% chance that we continue lower.
But that can't be a process, right?
Correct. You can't.
You can't say, well, we went 20% lower on the last one, so now we got 3 more until we have to worry again.
Right.
I don't want to say that to a client.
Correct. It's not a guessing. We might not know what the future is, but we don't need to guess on that future. And I think you brought up, ADPV, the Adaptive Select ETF, which is listed on the New York Stock Exchange under ticker ADPV, which helps investors access 2 of the most prevalent factors in markets, momentum and relative strength, using proprietary identification methods, the Adaptive Select ETF attempts to own the strongest 25 large cap stocks when the market is in an uptrend. And since not all market environments are the same, Adaptive Select seeks to prevent extended declines by moving to short-term treasury bills and cash during long-term market downtrends. Investors can find out more, including how to invest in ADPV, by visiting adpvetf.com or calling 1-833-880-5200. Investing involves risk, including possible loss of principal. ADPV is distributed by Quasar Distributors, LLC. And isn't that brief, commercial from our supporter, I think it says it well. You don't need to participate in extended declines. There's going to be corrections every year.
Every year.
But every year. There's the odds of a minus 10% correction is about 1 per year. But you don't need to hold on assuming that it's going to come back at this point. There could be further downside. Time will tell. We don't know, but from 20% corrections begin with 10% ones. And that typically happens below a 200-day moving average. So that's the environment.
What if you miss the best days, Dave?
Ah, yes, I love that.
What if you miss them?
Yeah.
You're gonna hate yourself come year end.
Right. And that's posted so much and written about so much that if you miss the best
days that happen right next to the worst days. How about I just avoid all of it?
Yeah. Why do research in a vacuum? You can't just look at best days. We'll go ahead and look at the worst days. Well, the worst days live in the same neighborhood as the best days.
And no matter how hard you try, you're not going to day trade yourself out of only being involved in the best days and somehow avoiding the worst days.
Right. That's exactly right. We know that below a 200-day moving average, volatility picks up. So that makes sense, right? If your volatility is picking up and you get a VIX that's above 16, you're now talking about 1% moves on a daily basis, and they can be up or down. And so, of course, your best and worst days are going to be together below a 200-day moving average. The math is not that hard, but you bring up a good point that's highlighted so much in financial media, and they do a great disservice to investors when they say something like that, because they don't sit there and count the worst days. Fascinating. And I know a couple of weeks ago, we highlighted the bearish thesis. And if we look at the S&P 500, we're still below the election gap. We're still below the January low. We're still below the zero line, still below a 200-day. We have levels to look at that if this market were to reverse and move higher, that you could start to participate again. Not a problem.
You've got some anchored VWAPs, depending on where you want to place them. Above some, below some. Obviously, still below the anchored VWAP from all-time highs. Below the anchored VWAP from those April lows back in 2024, the whole yen, Japan debt spook job. Below, you mentioned the zero line. We talked about July 2024 highs earlier. We can, get through this and then it's fine.
Right.
But I'm not going to sit here and stare at the computer screen for 7.5 hours until the close you're just not. Go outside. You can go play golf.
In Wisconsin.
Go out. You're below a 200-day. That's it.
Yep.
It's a simple line in the sand. I'm not saying it's the best. I'm not saying it works every time. There's nothing that does. But as far as the long-term trend, and you want to keep your sanity, I think it's a pretty good kind of barrier to entry to use on whether you want to be involved.
Yep. There are worse ones. So when you look at things underneath the surface or broadly, Ian, what things stick out to you from, a bullish thesis? And
when you go through what is working, it's just littered with foreign ETFs. So nothing has really changed from last week. I think you can put gold miners and silver miners in there. Gold and silver themselves, still kind of, precious metals, foreign stocks. So kind of like a 2020, or I'm sorry, a 2003 vibe, except for U.S. stocks aren't working.
That's an interesting dynamic that you bring up, because that 2003 to 2007 period, you did see international outperform U.S. stocks. You did see utilities outperform. You saw energy outperform. You saw financials outperform. You even saw gold outperform. Those are some of the same names that we're seeing right now.
Yeah.
I think that's a really interesting observation. And I know that you brought up, for example, participation or breadth, that we saw the bullish percent on the New York Stock Exchange.
Yeah, isn't that interesting?
Yeah, flip to X's, which is a type of indicator that shows potentially a new jumpstart for stocks on the New York Stock Exchange from a very low level. You mentioned it's in the 40s. That's information. Now we have to wait for price to confirm. And maybe this is just rotation into some of these other value areas that we mentioned and international. And that you see potentially U.S. stocks move sideways here in a 10% range because of tech underperforming. But you go ahead. You were going to say the only thing.
Well, I know you mentioned aerospace yesterday.
Yeah. Aerospace definitely strong.
Some pharmaceutical stuff, some insurance. I know Kevin's brought up insurance. But yeah, it's some commodities. I mean, energy's held up really well, given that the price of crude is pretty lackluster.
Yeah.
But we also saw that, right, in Q1 2022, and then we got a bear market. So, and then isn't that kind of one of those, when they draw the, people share the cycle charts, and it's like the bell curve looking lines, and it tells you like what stage of the cycles you're in and what outperforms.
Yep.
I feel like energy's always like the outperformer before a bear market, or that seems to be the case. Maybe that's a recency bias because that's what we got in 2022. But I have to go find.
No, I hear what you're saying. You're saying like what sectors perform well in different stages of the market.
Yes.
Yep. I hear you on that. And there is a chart out there that shows that. And energy, healthcare tends to be what leads in the first phases of a market correction. And maybe that's what we're seeing. Utilities as well.
What about copper?
Copper, isn't that interesting?
Yeah. I mean, right? You would think with all the, we'll call it uncertainty, or they say, these people in the media say that there's uncertainty. And right, copper's always been kind of one of those economically sensitive. Is that the right term?
Yeah, an industrial metal.
Yeah, that people like to look for as, a leading indicator. I don't know. I mean, copper's back near all-time highs. Won't get its highest weekly close ever this week, but I mean, it's right there. Well, so, how bad can it be? I don't know.
Yeah. Well, it matches kind of some of the strength that we're seeing out of China.
That's right.
Some of the European industrials, right? Because that's the second largest weighting. If you look at international stocks, typically you see industrials the second largest sector. And even when you look at the aerospace and defense names, ITA, XAR, PPA, Shield, SHLD. Well, SHLD is outperforming those other ones, and it's heavily weighted towards international companies. So there's definitely something to pay attention there coming out of international.
Well, and so we were looking yesterday at a lot of these ETFs that are geared towards electric vehicles.
Yeah.
That are really good. And so you're like, well, I think the most people, when they think electric cars, are like, well, I don't need any exposure to Tesla right now because that thing's getting walloped. But you go look what these funds are actually holding, and it's very big international flavor.
Completely agree. And we have seen a rise in the put call ratio.
We did.
I guess a nuanced and subjective comment to that, though, is I'm surprised it wasn't more, because really that when you see bull markets end, it's when they stop shorting. And I'm not ready to say they've stopped shorting. I'm not going to that extreme. You do have some messages on the wall, whether it's the fear and greed index at lows that we haven't seen since last summer. You did have a put call ratio that rose. You had a VIX that, went all the way up to 30 and has since moved lower. You really wouldn't be surprised if we were higher 6 months from now based on the current information that you have. But I will say that the shorting doesn't seem as extreme as maybe you would anticipate for a 10% correction. And you just add in how, like I'll use in a microcosm Microsoft, what Microsoft looks like. It has a pretty well-defined neckline. And what I mean by neckline is where they've supported Microsoft price in the past, near $396, and we're below that. And that's actually, targeting price down in the 350s, 330s. And if we get something like that out of Microsoft, or you get NVIDIA breaking down, and I know you mentioned this morning, Micron, the price response to earnings.
Yeah, the people who are better at that stuff than we are, they say it was a good earnings call, and yet the reaction, not so great.
Right. And that's what we really care about, is what's the price reaction. And if NVIDIA is the poster child for the last cycle of price movement in an uptrend for the overall market, if it's the leader, and they've done nothing but sell NVIDIA since its blockbuster earnings on February 26th, that's information. Because it's not about the earnings themselves. It's because it's the price reaction, right? How many times have we seen, Ian, in our tenure managing money, amazing earnings and they sell the stock, or absolutely terrible earnings and they buy the stock?
See it all the time.
And then
time.
And then you'll see investors say, well, that's crazy. The market's got to be wrong on this. No, if your default setting of understanding is the market is always right, that gives you permission then to acknowledge yourself that I am wrong. I'm wrong, the market's right. But that's a anti-pride statement. Like you're speaking against yourself. And for some people, that's very threatening to say that you're wrong, even though I would argue that's one of the strongest and most powerful things you can say is I am wrong, or I am sorry, or, those type of things. I don't know. Those are powerful statements and freeing, because the market's not wrong.
I think it's easier to get sucked into that the more time and energy you spend on finding investment, finding trade ideas.
Right.
I mean, how long would you say you think about when you pull up, or when you ask yourself, should I own Argentina for clients? How long does it take you to make that decision?
Like, I don't know, 10 minutes maybe?
If even that.
Right.
But if you're right, when you've spent hours, tens of hours researching and pouring everything into trying to find, the great best stock from like a fundamental standpoint, whether it's super cheap now or you think it's just going to be the next blockbuster hot name. I think it's really hard to admit you're wrong when you've put 40 hours of research into something versus when you put 5 minutes.
Yeah, that's that sunk cost bias, right?
And then the idea that, oh my God, would you sell this? I mean, you're going to sell that 48 hours later, Ian, just because it wasn't working out? Yeah. Yeah, that's exactly how that works.
Yeah, and we do this all the time in our lives, right? Like you purchase a car, you purchase a house, and you spent a lot of time on it, did a lot of research, all that different things, and and you close the deal, and your natural inclination then is like, I did a really good job here. And you look around and, oh, look at all those other cars that are just like mine. They're really smart. And then all of a sudden you could have all sorts of problems with your car. Well, maybe your research was wrong. It's just, it's one of those things that sunk cost, that commitment cost bias. You marry stories rather than understanding that price knows more than you do, right? Because price includes everything. I mean, there's trillions of dollars at stake, people's livelihoods, people's careers tied to that. And price reflects, it's the manifestation of opinion and final arbiter of value. You don't get to disagree with price. I mean, you can, but I don't recommend it.
Who would you call if you had a disagreement
with price?
Who are you getting on the phone with to yell at?
It makes me think of some of those crazy like Reddit comments about like, hey, can I turn my stock back in? It's not working out. People who bought something and it's down 20%. Can I return this? Is that how it works?
Not pillows and bedding.
Yes, correct. So we still have strength out of international. We have value areas doing better than growth. What are we seeing out of, you mentioned copper. How are other metals looking, like gold, silver, things like that?
Palladium, not really, another precious metal, right? Is that palladium's a precious metal, right?
Yeah, I think that falls into industrial too. Like it's precious industrial because
maybe platinum.
I think you're thinking of platinum because I believe palladium is like used in like catalytic converters.
Okay, so this shows you how much I know about the metals.
Palladium.
I do know about their price charts. Yeah, I mean, not silver kind of hanging out. We mentioned copper, gold still. Now gold's getting hit today, but I mean, still strong relative uptrend.
We have the dollar still sitting within its range.
Yep.
The trade weighted dollar still sitting below 104, 105.
Orange juice for breakfast enjoyers. You'll be happy to know that orange juice is down like 4. I looked at this yesterday. So we are 50% off the highs. From a chart, that's probably the cheapest it's going to get now.
Yeah.
I don't think
eggs too. Breakfast got cheaper.
Yes.
You can look across a wide spectrum of information. And on one hand, you have broad U.S. markets below 200 days. Meanwhile, you do have some sectors that are above 200 days. You've got international stock strength. You have crypto weakness, precious metal strength. So it's a little bit of bifurcation out there. It's not we still haven't seen, if we're going to get like a massive, massive correction, we haven't seen correlations go to 1. Like we haven't seen just broad-based selling across everything.
No, we have not.
And so again, it wouldn't be surprising to see the year finish higher for U.S. markets, but really that's on the all-stars of the market. I mean, that falls on your FANG stocks, your Microsofts, your Apple, NVIDIA, Amazon, Google, that it's really going to be on those large cap names for that to be the case. And we still haven't seen small caps, carry the bucket. So it's definitely a mixed market out there. And time will tell whether we reclaim the 200-day, like you and Kevin touched on. It could happen next week. It could happen in 6 months. We'll be more than happy to participate when that happens. Right now, it's not like that.
Isn't that the best part? You don't have to participate.
Right.
You don't have to. if broad market indices, breadth, whatever you want to look at is saying this is pretty blah market, you can just go hang out and do other things with your life. It is possible. Like, that's a decision that you're making for clients. Just go to cash.
And I do think that's an appeal of the supporter of this podcast, is that that's happening automatically inside an ETF is pretty powerful, that you don't even have to push a button. It just happens for you inside that vehicle and is no longer exposed to the market.
But if you go from equities to cash, if the ETF does that, then you got to worry about the capital gains.
No.
No?
No. That's the beauty of ETFs. One of the greatest tax benefits of holding an ETF is that you don't incur the cap gains until you sell it, and anything that's happening inside of there defers off the capital gains. And so the things that were held inside of ADPV that got sold this last week, and the cap gains that went with them, got pushed off, and it's not experienced by the holders of ADPV until they sell it.
So they're not going to get like a massive distribution in late December?
Yeah, I mean, there's ETFs always have a possibility of some cap gains, but it's not like something you'd experience with like a mutual fund.
Oof, that's good.
Yep.
Well, good for them.
It's awesome. Very thankful for that type of tax structure. But wrapping up the podcast here, Ian, anything else you want to highlight before we close this one down?
No, just hanging out. No reason to stress. If I don't want to see the market go down. I don't think anyone roots for that, but that's not reality. And you don't have to sit there and worry day after day if you're going to miss a bottom, if you're too late to get back in, or stock's going to go down further. If you've made a decision beforehand, right? You got to make that decision beforehand, which for us is a 200-day. Doesn't really change. But if you're trying to figure out now, yeah, tough.
Well, and it's just mathematically truthful to say that if buyers regain control of this market and price moves back above a 200-day, we can get the car out of the garage and drive again.
Yeah.
No
Put the
problem.
top down.
Yep. Put the cruise control on. And then if we're back below a 200-day and it's snowing, we park the car. We don't have to markets are complicated the way they are. Let's not overcomplicate this.
And you say, oh my God, Dave, so you got the car out and then 15 minutes later you were back in the driveway? Yeah.
Yep.
Yeah, that happens. Sometimes you get to drive for 18 months. Sometimes you get to drive for 3 days.
Right. I mean, this could be, this environment could be similar to October, November 23. We don't know that yet.
Yes.
But I mean, being uninvolved with the market for 1 week in late October of 23 and then getting back involved in November when the skies cleared up and the roads are dry, that worked out pretty well. And I'm more than happy. I love getting the car out of the garage. Like, I like it when markets go up and you can participate.
I can buy a car not to drive it.
Right. But there's times where you don't, because you like the car and you want to protect it. God, we went full circle on that analogy. Pretty good. Thanks for riding along with me on that one, Ian.
Oh, I like that. I see what you did there.
Well, excellent. Well, I appreciate you doing this with me, Ian. We hope everybody listening to this appreciate it as well. We have a mixed environment out there. We have U.S. markets below their 200 days. We have international market strength. We have some strength out of precious metals, not so much strength out of crypto. Mixed bag for fixed income, which we didn't touch base on this week, but maybe we'll do that next week. But Ian, as always, appreciate you having on here. And those listening, if you could give us a high ranking and share this with others, that's a compliment to us and we appreciate it. Otherwise, we'll talk to you next week.
All right. Have a good one, everyone.